Hello everyone, Merry Christmas to you all. In this video, I would like to review the performance of quantum long-term equity. But before that, this is the quantum mutual fund page at Value Research. It gives you all the mutual funds that quantum holds, that quantum has with the net asset value and other parameters. If you notice, quantum long-term equity is the flagship fund for the AMC. That's the only fund which has got three-digit AUM in terms of crores, and and therefore it just cannot afford to let interest in that fund slide down because the AMC does not have any distributors pushing the product, so its visibility is not very high online wise. It's got a community which likes the way they operate, and they recommend it to others, and that's how they have built a base, at least to some extent. So let's look at how this fund has performed. It's clear to many of us that this fund has slipped in performance. It was a five-star fund a while back. Relatively speaking, of course, I'm not talking about its performance, but performance with respect to the category as a whole. It was a five-star fund, but it has slipped down, and it's obvious that it has slipped down, and that is not good for the AMC. Especially for quantum, because there's no other fund which is doing well. So let's look at this review. This is going to be a slightly longish review because I'm going to show you some aspects of fund review that I have not shown before. I have done two review videos, one of HDFC equity and one of IDFC Premier equity. So now let's look at this one, and it's going to be slightly longish video. Let's get into it. This is the quantum page at Value Research. So let's look at the performance tab here. Like I showed in the HDFC equity video, you can click all here, and then you can select either a 3-year window or a 5-year window, and then slide it around. For example, if I click 5 years here, that's the last 5 years. Now, quantum is benchmarked against the BSE Sensex Total Returns Index. That is the benchmark has got its dividends also reinvested, and then the index is calculated. So beating such an index is a lot more harder than beating just BSE Sensex, like many funds have benchmarked themselves too. Now, this is the 5-year window. Of course, Value Research is missing some data there, but that doesn't matter. It's available. The Total Returns Index data is available for free at the S&P website. You can get it there. Now, if you look at 5-year windows and slide this back, this is not bad at all. The fund has typically bet its benchmark in 5-year windows. Of course, it not initially, but then it picked up. But if you did the same for 3-year periods, and then it's not a rosy picture. Here it's okay, but there have been periods initially to begin with where it has not done well. Also, if you look at the most recent 3-year periods, that's the most recent 3-year period. Last 3 years, it's not done exceedingly well. So that's the problem. That's basically the concern that investors have. Well, if you look at annual returns, I think that's a pretty good show. The fund has typically managed to beat the benchmark quite well. It has not fallen as much as the benchmark during down years, and it has also managed to come very close to or even beat the category average. Of course, there are some years where it does not bet. For example, the last year it does not bet the category average. In 2007 it did not beat, but then other years it's been quite okay. So it's, annual return wise, it's been fine. Outperformance wise, it's been okay. Now, let's look at downside protection. This is what I did for IDFC Premier Equity, and this is upside and downside capture ratios at Morningstar. Now, if you look at the long term, well, this is not actually a very old fund. It's about 8 years now. I'm not 8 years or so. I don't exactly remember. Well, it's definitely not 10 and 15. That's why those entries are blank. So let's look at 5-year returns. Now, over a 5-year period, the fund has only captured 93% of the benchmark's positive returns. Please note that this benchmark is BSE 500. This is not a proper benchmark for quantum, because although quantum is benchmarked to the total returns Sensex, it can pick any stock from the BSE 200 universe, not from the 500 universe. So this is not an appropriate benchmark, but let's go with it and see how it is done with respect to 500. So that's a broad market index, but that's how they use in terms of flexi cap or multi cap, whatever Morningstar calls it. So over 5-year period, it has only captured 93% of BSE 500's upward movements, but has only captured 73% of its losses, which is a good thing. And this is higher than the category average. The category captures 86% of the benchmark's losses, while the fund has only captured 73. 3-year period, it's 69% of the losses, whereas the benchmark has captured a lot more. Now, in the last 1 year, its performance has not been good because it has captured more losses than the category, and it has also captured less returns than the category. Well, there are a lot of theories for it. Some people say it's because they held cash for a long time and so on. I don't know. I don't get into that details. It depends. Personally, I think just because a fund holds cash doesn't mean it has to underperform. It may hold stocks which whose calls could have gone wrong, or maybe it's just waiting for them to come good. I don't know how that works. It's I don't think it's just speculation, and I think it's better not to speculate. I think it's better to look at the data that we have and work with it. Now, I would like to introduce to you two of my Excel tools. Now, this is, let me get here. This is, just make it a little bit bigger for you, the multi-index mutual fund rolling return analyzer. Rolling returns means that you pick an interval, let's say 1 year or 2 years, and then you roll the duration over. I did a post on how to define short term and long term. That's yesterday's post, so you can have a look at it there. Now, for example, suppose I invest on 1st of January. So after 1 year, that's on December 31st, I'll find out the return. That's 1 year. Now I roll the duration over. Now in this sheet, I roll it to the next business day. So I now roll the period from 2nd January to 2nd January, let's say 2000 to 2006, let's say to 1st January 2007. So I have shifted the window by just 1 business day. Then the next return calculation will be from 3rd January 2006 to 2nd January 2007 and so on. So I keep moving the window and I calculate the CAGR over that window. And that window is basically this here, step 6. Enter the interval over which the rolling returns has to be calculated. This is 365. I've linked it. I've made some small changes in the sheet for you to understand the performance of quantum better. So you can use it typically for 1 year, 2 year, any number of years, but the number of data points that you analyze will become lower when the duration becomes higher. Now, this particular sheet does not use the total returns index. So I have manually fed in the values of the total return index for us to analyze it. So let's head over there. Now this is over 1 year periods. Now there are several data points on this sheet. Although the data points are not seen, there are several data points on the sheet, and for both the benchmark and the fund, and it will give you an idea of how consistent the fund manager has been able to beat the benchmark, how consistent his performance is. Now over 1 year period, you notice that there's hardly any outperformance. This will be true for any equity mutual fund, typically any equity mutual fund. So your 1 year rolling return period is very short, so you will have to make it maybe 2, 3, 4, 5. Let's do 3. Wait for it to calculate, and that's 3. Notice that up to about August 2013, the fund has managed to decently beat the benchmark consistently, but after that the performance has dropped down. Now I would like to point out here that 14th August 2013 here means this is the return for an investment made 3 years before. So this date on the x-axis is the end of the period, end of the investment period. So you can see that the performance has dipped from August 2013 onwards, and that's why people are worried. And I think that's a fair worry. Now, is this a good thing or a bad thing? Will the performance pick up? Should I exit the mutual fund on this basis? Well, I don't think anybody should think like that. I think 3 year period is too short. I think 5 years is good. In this case, if I hit 5, it looks okay again, but the margin of outperformance has gradually come down, but it seems to be picking up here. I hope this picks up. Now, the point is that this is all right. I mean, it's clear that even in this scale, although the number of data points have come down, notice that we are only looking from February 2011 to December 2023. So it's a short window to judge the fund end. It has done reasonably well. These kind of ups and downs will always be there. I don't think this should be the reason you should quit the fund. I think you should look at your portfolio. I'll come to that in a moment. But let's first look at another tool that I have. Now, this is the SIP rolling returns calculator. The sheet that I showed you earlier calculates only the CAGR. That is a point-to-point investment. So it's like you invest a lump sum and then you find out the return after 3 years. Shift that duration by one each business day and calculate. So you're only calculating a CAGR, a lump sum return calculation. This one is an SIP return calculation, and in this case you can choose the Sensex total return index, but of course the data has to be updated from the BSE index. In this sheet you have to take the update. For example, if you did the calculation 3 months ago, if you want to do it now, the last 3 months data you should take from the links are there. You should take it from the S&P website and paste it and then run the calculation. This calculation will take a while because it has to iterate over every 3 year periods between since inception, since April 3rd 2006. That's when the AMFI gives out now data, so it has to iterate, so it will take a while, so I cannot show you the calculation here. Maybe I can talk while it gets done. Now I have set Sensex total returns index here, 3 year periods here, and let's look at the results. Now if you look at 3 year SIP, now every data point in this graph represents a 3 year SIP XIRR return. Again, from about August 2013, the performance has definitely dropped. Is this intentional? Are they saying, look, we are a long-term equity fund, therefore 3 years is not a long term, you should be more patient, and so on? I don't know. These are it's very difficult to judge these from outside unless you know what the fund management is doing and the picks, when they pick it and so on. I think it's best not to judge on this aspect. It's not great, but definitely there has been a dip in performance, and that's a fact. I can't deny that. I am an investor, and that's fact. So let's maybe run it for 5. It will take a little while, and maybe we can talk a bit about what I intend to do. So let's do this, and while it runs, now I have been investing in this fund for the last nearly 4 years. I'm not exactly sure. I need to check my XIRR from this fund. I do not do a monthly SIP, but I invest typically each month. But sometimes I don't invest in the same fund each month. I do a little bit of juggling. I'll come to that in a separate video. But my XIRR from this fund is about 14.5-ish. It's between 14% to 15%. Now, um, well, my expectation from equity is only 10%. If I'm lucky, 12%. So 10% is enough for me. So compared to my expectation, 14 to 15% is pretty decent. So the 5-year results have come, and let me get back to the portfolio in a moment. So this is the 5-year results. Each point represents a 5-year XIRR, and that's pretty good. I think that's okay. I think you should. I think you should wait. I personally, I think I'm going to wait. I'm going to continue investing in this fund. The reason I'm going to do that is because one, the returns are above my expectation. Two, my net portfolio, uh, my net XIRR. I have certain funds. This is tagged to my retirement goal, and I have other funds in my retirement goal. Please don't ask me what. The net XIRR for my equity retirement portfolio is about 14 to 16%. It's around this percent. I have not looked at it recently. I think it's about that, but I'm pretty sure it's that. And so quantum is an average performer in my portfolio. It is not a star in my portfolio. I have got above average performers in my portfolio. Uh, if you want to know what, well, it's PPFAS, HDFC balanced, and so on. But mine is not a great portfolio, but because it's an amalgamation of past mistakes, so don't expect it to be perfect in any sense. It's not at all, but it's good enough for me. So I think it's an average performer, and I don't think I want to exit this fund because it has a decent downside protection in the past. It's the volatility in its CAGR has been quite low, at least for my portfolio. I've been looking at it, and I think as of now, I think it's okay. But I believe that quantum um, should worry about the fact that it's relatively speaking the fund has not done well because this is the only fund which is popular. I mean, other funds have extremely poor AUM. So if this fund slips, then they're not going to be able to uh, get profits. That's my view, uh, because they had they uh, they had done an article some maybe a year or two ago that they will be able to meet the SEBI net worth criterion on their profits alone. That has not happened. They had to get into a merger and transfer, which led to some transfer of net worth, and only then they were able to meet this SEBI criterion. So they were not able to get profits. I think it's probably because of this, and I think that's not a good idea. It's my view. I could be wrong. I'm an outsider. I have nothing to do with quantum, but I think it should pick up fast. Otherwise, it's not a good thing for the aims. Catch you in another video. Bye bye.